Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Neil Pollak, President and owner of OnBeach Advisors, a 20-year-old independent marketing organization representing over 60 insurance companies with a national distribution network of index and fixed annuities, as well as life insurance products and hybrid long-term care programs with their strategic partner, ECA Marketing. Their products and marketing platforms are distributed through broker-dealers, financial planners, life insurance agents, and registered investment advisors. Neil, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill. Pleasure to be here, and thank you for having me on your show.
Yes, of course. And how does an index annuity work?
Well, an index annuity, and the inception of the index annuity is 1995. It's designed to complement and be an alternative to CDs and fixed rate products like annuities. The key to the index annuity is to have the no risk, no market volatility element. And the other key ingredient in the formula is to have no fees. When you look under the hood of the index annuity engine, I guess the best way to do it would be with an example. When the insurance company puts together an index annuity, and I'm just going to use $1 as an example, an individual puts $1 into an index annuity, approximately 90 cents of that dollar goes into the no risk aspect. That is bonds, mortgages, treasuries, that sort of investment. So that's what guarantees the principal in an index annuity. The other 10 cents in my example goes into what's called the options budget. And that's what establishes the caps and participation rates, which gives us the upside potential in earning returns. And I'll just finish about how an index annuity works. Unlike a CD at a bank or a fixed rate annuity, which has a declared rate of return, here our rates are subject to the performance of an underlying index like the S&P, Nasdaq, something along those lines.
And Neil, what is unique to the index annuity product design?
Beautiful question, Jill. So in doing this for many, many years, what I found that most advisors don't know, and many of the clients who purchase these products don't know, is something called a reset provision. And this could be done for a 1-year period, and for our purposes, we're going to talk about an annual reset, but it could be for 2 years or 3 years. So what this allows the investor to do in an index annuity is to lock in gains each and every year on their anniversary date. So for example, August 22nd, if we were to invest, let's say $100,000 in an index annuity today, next August 22nd, we lock in our gains. So as an example, we look at the S&P, and I'm going to just round at 4,000 as the starting value for the S&P. If next August 22nd, 2023, it's up 10%, so now the S&P is at 4,400, we lock in our gain. We can never lose that rate of return. The following years, it goes up another 10%. We're now at 4,800. We're up 20% in total. We lock in the gain. And let's just say, similar to 2008, we have a severe correction in the market, and we go from 4,008 on the S&P all the way to 3,000. We didn't lose any of our gains. Our 100,000 is still worth 120,000. But the interesting thing is, now we start calculating our returns from 3,000. So we don't have to get above 4,000 to make money. We make money when the market goes up. We lose nothing when the market corrects or goes down, but we start at the lower, let's say, S&P value in determining future gains.
And finally, what innovations have evolved over time in the index annuity marketplace?
Sure. Again, a wonderful question. So the base product was designed to be a pure growth vehicle, as like I said, an alternative to CDs at a bank or fixed rate annuities. But with innovations over time, we've added riders or provisions that allow the program to be used with different clients and different objectives. For example, many people want to have a pension or a lifetime income. So the base index annuity now might have an income rider that there might be a charge for that, or there may not be a charge for that, but you have the option of having an income rider. That income, which is a lifetime income, could be paid for one individual's life or joint life. It could be level or static income, or it could be increasing income designed to offset inflation, let's say in the future. So one of the main innovations has been lifetime income, single or joint, static or flat, or increasing income. Other innovations have been many clients cannot qualify for long-term care or life insurance. So there's provisions on the index annuity to allow these to simulate, and that's a good word, simulate, because it doesn't have the same tax-free aspect as true long-term care or true life insurance, but it allows for the income to be paid out either as a multiple for long-term care if an individual cannot perform, let's say, 2 of the 6 activities of daily living, or it could simulate a lump sum or a 5-year payout on death. The other innovations that have taken place are, I'll just call them esoteric or exotic indexes, like Pollak Insurance Company has Raven Pack and Atlas, and I believe today they're announcing the Nasdaq index to their lineup. And the last main innovation is the ability to go into an index annuity and buy up the participation rate. So as an example, somebody goes into an index annuity at a 50% participation rate and there's no fee. Well, now we might be able to get 80% participation rate on the S&P in our index annuity and be charged a fee, maybe 1% a year. So the idea of buying up our participation rate or our cap rates is the newest innovation in the marketplace.
All right, Neil, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.